We are focusing on the national portion of the life insurance exam, specifically looking at modified endowment contracts and the 7-pay test. To understand this concept for the exam, you must first recognize that the Internal Revenue Service does not want life insurance to be used strictly as a high-yield tax-sheltered savings account. To prevent this, the government implemented the 7-pay test, which measures the amount of premium going into a policy during its first 7 years. If the cumulative premiums paid at any time during those first 7 years exceed the cumulative amount that would have been needed to pay up the policy in 7 years, the contract is classified as a modified endowment contract. It is vital to remember for your test that this is a cumulative calculation. If you have a $500 annual limit and you pay nothing for 2 years, but then pay $1,500 in the third year, you have stayed within the $1,500 cumulative limit. However, if you paid $2,000 in that third year, you have exceeded the limit and the policy becomes a MEC. On your exam, you will likely encounter questions about the taxation of these policies. Standard life insurance policies enjoy first-in, first-out treatment, which means your cost basis comes out first tax-free. Modified endowment contracts are different because they use last-in, first-out, or LIFO taxation. This means the very first dollar you take out, through a withdrawal or even a policy loan, is considered taxable interest until all the growth in the policy has been accounted for. This is a major trap on the exam because many students assume loans are always tax-free in life insurance. But for a MEC, a loan is treated as a taxable distribution of gains. Furthermore, the IRS applies a 10% tax penalty on any taxable distributions taken before the policyholder reaches the age of 59 and a half. This makes the MEC behave much more like an annuity than a traditional life insurance policy in terms of tax penalties. You should also be prepared for questions regarding the duration of this status. Once a policy fails the 7-pay test and becomes a modified endowment contract, it is a MEC for the life of the policy. There is no way to fix it or revert it back to a standard life insurance contract later on. A useful mental shortcut to keep the taxation straight is the phrase MEC stands for Most Earnings Are Charged First. This will help you remember that the interest or earnings come out of the policy and are taxed before the principal is touched. When you are sitting for the exam, look out for trick questions that claim the death benefit becomes taxable. Even though the living benefits like loans and withdrawals lose their tax advantages, the death benefit of a modified endowment contract typically remains income tax-free to the beneficiary. The exam will also try to confuse you by suggesting the 7-pay test resets if you change beneficiaries or make minor administrative changes. In reality, only a material change to the policy, such as a significant increase in the death benefit, can trigger a new 7-pay testing period. Focus on the fact that any policy that is overfunded too quickly will trigger these permanent tax consequences, and you will be well prepared for any MEC questions on the national exam. This topic is a favorite for examiners because it combines premium limits with complex tax rules, so stay focused on the LIFO rule and the cumulative nature of the 7-pay test.